Hi, good evening, everyone. My name is Samir Bhandari, and I'll be running this webinar on the psychology of fear versus greed. Thank you for joining this webinar, our educational series 5. The title today is The Psychology of Fear versus Greed, Breaking the Investor's Dilemma. A bit about me. Next slide, please. Just a bit about me. I'm a chartered accountant. I passed out in '87. I went to IIM Ahmedabad where I graduated. After that, I spent more than 30 years in banking, almost 35 years in banking. I worked in Bank of America in India, worked in Bank of America in Hong Kong. I worked in UBS in Singapore. I worked in JP Morgan in Singapore, where I ran their South and Southeast Asia businesses. And finally, I worked in Nomura, where I not only ran the Asia business across all rates, FX, fixed income, and equities, but I was also co-heading their sales globally. I've been obviously investing in markets for almost 35 years, and have seen a lot around the crisis. Have seen a lot of greed, have seen a lot of fear. In fact, when Lehman went down, I was actually in Lehman Brothers, and I saw fear right in front of me there with people around me. So I have seen a lot in this industry, and I just thought, it's a good idea to share some of my knowledge, or at least what I know, with people on this webinar. Now, this is an education series which we do. This is the 5th session, in fact. So this session, in fact, I've done it a few times earlier also. But I think it's very, very important for investors to understand when they should be getting into the markets, how they should be looking at the markets, how they should be looking at greed, how they should be looking at fear, because that's where investors make a lot of money. If you actually understand the market psyche, I actually feel you can beat the market. So that's what we'll actually be discussing today. Next slide, please. Before I get into the fear and greed index, why are the markets really going up, right? I mean, if you look at the US markets are at an all-time high. And why are they going up? The investors expect a soft landing. People expect the Fed to start cutting rates as soon as June. A lot of people are talking about 3 to 4 cuts this year. People feel that inflation is in control. The results which have been coming out, so last quarter results which came out, have been very good. Almost 80 to 85% of the companies beat their estimates. So all in all, it's been very, very, very positive. Similarly, in India, I mean, GDP growth, they're looking at 8%. Inflation is down to 4%. The government is very, very stable and expected to come for another term when the elections are held in June, May, June. So obviously, all the positive news is there. And that's one of the reasons why the markets have really been doing so well. I mean, markets in the US are at an all-time high. Markets in India are at an all-time high. So how should an investor, or actually wrong question, what should an investor be doing now? Obviously, a lot of people have been in equity markets. People have made a lot of money. In fact, I invest both in the US markets and in India. And fortunately, the first 3 months of this quarter have been fantastic. In the US, S&P 500 is up 10%. The tech index is up almost 9.5%. And if you were actually involved with AI, you could be up 60, 70, or 80%. So all in all, it's been very, very, very positive. And AI has given a big, big boost to the equity markets in the US. In India, again, the infrastructure story is extremely good. Except for banking industry, most of the other industries have done well. Companies are doing really, really well. And the focus has been on efficiency. And that's what's leading the markets up. But I feel now is the time for caution. In my last webinar, which I did, I said we should take 20% money out of the market. Today, I would say take out total of 35% and keep it in cash or liquid instruments. 60 to 65% can be in equities. Absolutely not a problem. And I do feel equities will continue to do well over time. But I think the opportunities to enter at a much better level are going to come soon. And that's what I'm going to do personally. In fact, I've started selling today because I do feel, though this rally has done very well, AI has been an amazing push for the markets, but I do think there's some kind of exuberance which is coming in, which is going towards irrational. So that's one of the reasons. But let's talk about the fear and greed index. And I would urge every investor to actually look at the fear and greed index on a regular basis. And how do you actually calculate this? So today's fear greed index is around 70. It looks at 5 or 6 factors. It looks at market momentum. It looks at stock price strength. It looks at the stock price breadth or the volume. It looks at market volatility. It looks at put and call options, safe haven demand, stock versus bonds, because government bonds are considered to be safe haven, and the junk bond demand. Now, a lot of this is, I would say, linked in a way to the US, but it is very, very highly correlated to India. So I would say if you can look at this index on a regular basis, I think decision making actually can become much, much easier for you. So I'm going to just talk about each of the factors which it takes into account. Next slide, please. So if you look at market momentum, it's basically what it does. It compares the index or the market against the 125-day daily moving average. And if the index is higher than that, then it shows greed. If the index is lower than that, it actually shows fear. And that's mainly, this is obviously momentum driven by actually momentum. But this is what we are seeing in the Indian chart. A similar chart is there in the US too. I mean, you look at the momentum and it's way above the 125 DMA. And look at over time, we've gone back as long as 2009. It actually predicts quite well, I would say. So I wouldn't be surprised if this market comes down to closer to the 125 daily moving averages. Next slide, please. This is again Sensex. We saw the Nifty. Now it's a Sensex, similar kind of momentum. Next slide, please. So this index also, the greed index or fear and greed index also looks at stock price strength. It's an analysis between the 52-week highs and lows of the stocks. If there are more stocks making 52-week highs, obviously people are very bullish. And that's really talking about greed. When the stocks are making 52-week lows, that's when there is real fear. And history has proven when there is extreme greed, markets come off. And when there is extreme fear, that's when you really want to get into a big way. And we can talk about various times, right? I mean, you talk about the Lehman crisis, when markets collapsed, people got in, they made a lot of money. The internet boom and crisis that time. And there have been various instances. I think you've got to just take advantage of when there is fear. So wherever there is fear, where people are not going in, you have to jump in. And wherever there is greed, moving towards extreme greed, you've got to be extremely, extremely cautious. Do not look at making the last 3, 4, 5%. Let someone else make it. But you've got to make sure that you are protecting your capital. Next slide, please. Obviously, stock exchanges have a lot of stocks. And investors buying and selling. So if the volume of shares that are rising or compared to what the number of shares that are falling, then it again shows greed. And this chart again shows that. It's basically all the charts today are pointing towards greed and moving towards extreme greed. And that's why I want investors today to be very, very cautious. And that's why my call that you need to, I earlier said 20%, now I would like you to be 35% in cash or liquid instruments. Next slide, please. This market volatility, which I think again is very, very important. It's called VIX. It's calculated on a monthly basis. If VIX is very low, it's basically because markets have reached a stage where they do not fear anything. When they do not fear anything, it means there's a lot of greed. So this again, I think, is very, very important. Today in the US, the VIX has fallen to 12.5. And just to give you perspective, when Lehman happened, this had gone to close to 80. When COVID happened, all these volatility numbers had gone through the roof. And that's one of the reasons stocks fell so much. VIX is actually, it's dangerous today, if you ask me. VIX is at an all-time low, and I was looking at the charts. It's really, I mean, look at this chart. It's really at an all-time low. So you've got to be extremely careful around it. Next slide, please. This talking about, again, S&P, similar kind of chart to the Indian VIX. Again, pretty much all-time low. If you see 2006, you haven't never seen this. And I'm not sure whether, VIX will really spike massively, but definitely volatility is definitely going to go up. I am expecting at least a 5 to 7% correction, if not more, in S&P, and I think the Indian markets will actually follow. Next slide, please. This is another factor which is taken into account when greed and fear indices are calculated, is basically when the call options or people want to buy more stocks is much more than people who are buying puts or who want to sell. That's when there is greed. And there is fear when more and more people are scared of the equity prices going down, and they buy a lot more puts in the market. So this is one of the factors which is also taken into account in the fear and greed index. Next slide, please. Safe haven demand, when you have government bonds outperforming equities, that's when there is fear. When equities is outperforming government bonds, that's when there is greed. Again, one of the factors which is taken into account, because stocks obviously are riskier than bonds because they are much more volatile. Next slide, please. This again, another factor taken into account is the junk bond demand. What are junk bonds? Junk bonds are basically below investment grade bonds, and typically they trade at a decent spread over government bonds. When this spread continues to come down, it again shows greed. It shows money chasing assets. That's what we call greed. When money is not chasing assets, or when money is dumping assets, that's when we have fear. Today, if you look at the spreads, it's again moved towards extreme greed. So all these factors put together are pointing to signs where investors need to be very careful. I don't think it's obviously the market fundamentals are very strong. So don't get me wrong on that. I think market fundamentals are probably one of the strongest, right? You look at India, you look at global, it's been just amazing. But we've seen a rally which has gone from almost 5.5 months. And that says, okay, have we just crossed that line? It's quite possible that for the next 5, 10, 15 days, this rally may actually continue. But I think the time has come to start taking money out if you haven't done that, and go almost as much as 30 to 35% in liquid bonds or cash. Next slide, please. Next slide. So this is what I spoke about, right? Fundamentals looking really good. But when you have these crisis times, that's when fear actually sets in. Right now, there's actually, if you see, there's nothing on the horizon which shows why should there be fear. But what we have seen in the past is good times do not continue. Maybe there could be some conflict in the world. It's already going on. Russia, Ukraine has already been going on. There's a Middle East conflict. Markets have actually not been affected by that. and growth has been relatively good. But you do not know anything about external factor. Maybe there's going to be an oil shock. So all these factors are there which you need to be very, very careful. But today the fundamentals are very, very good. And especially talking about India fundamentals, I think they're the best. I mean, if you compare India to any of the emerging markets, I think India is probably the best, highest growth, growing emerging market. So I think that's going to continue. But again, signs are that there could be some pullback, especially in the equity markets. Next slide, please. Here again, we've spoken a lot about this, so I won't dwell on this. But there have been times when there is fear, and that's when you really want to bet your house on. I mean, can you imagine people who bet money in the Asian crisis, people who bet money in 2008, people who bet money in COVID time when markets corrected so much? That's what you want to do. But for that, you need to have cash set aside to buy. A lot of times what happens with investors is we are all fully invested in the markets. We've not taken money out of the markets at all. So when these times come, we actually do not have the money to invest. And that then becomes a problem, which is the reason I keep harping on the fact that you've got to take money out now. Next slide, please. This just talks about interest rates. I won't dwell too much on it, but expect Fed to start cutting rates in June. Once that happens, I'm sure RBI will also follow through. Expect anything between 3 and 4 cuts this year from the US. Next slide, please. Now, what happens on currencies, right? When there is fear, the dollar strengthens. And this happens globally. When there is greed, typically the dollar weakens. And this is what we've seen over time. So if the markets sell off, you will see the INR weakening. And I personally think that will happen. And it could happen as early as April or May. So just keep an eye for that. Next slide, please. This is over time how INR US dollar is done. I do think India is now in a position where the rupee depreciation is not going to be as much over time. Gold has been used as a hedging. Sorry about the title, but it should be gold. Talking about gold. Gold has been used as a hedging instrument whenever there has been fear, whenever there has been inflationary trends. And I think that will continue to be. Next slide, please. Inflation, we spoke about inflation. Inflation has come off, starting to come off further. I do feel the RBI, as I mentioned last time, one of the best central banks, and they've been able to control inflation really, really well. I do feel inflation will come off and RBI will continue to cut rates. Next slide, please. This is really the chart around the US inflation continues to come off. Fed's target is 2%, and I think they'll probably achieve it in probably early next year or mid next year. Next slide, please. So let me stop there. I just wanted to basically summarize what I've said. There is greed in the market. Fundamentals continue to be very, very strong. But I think the market definitely has overshot. Results of the companies most of the companies everywhere are doing extremely well. And I do think once the Fed starts cutting rates, you will see the rally starting. But I do feel there is the exuberance which we are seeing now is gone a bit too far. And hence, I would urge you guys to take money off the table. My guess is 30 to 35% would be a good percentage of taking money off. So let me stop there. Thank you for that. Thank you for listening patiently. And I'm happy to take Q&A for the next 20 minutes. Please feel free to ask any question. Every question is important. So just got a question. Any specific sector you're bullish on? In India, I would say I'm bullish on infrastructure. I continue to be bullish on public sector banks. I mean, I know it's gone up a lot, but definitely bullish on that. So I would say any sector where the government is focused on, I think should be good. Longer term, I would also say I'm bullish on banks in India. They've come off quite a bit. So definitely bullish on that. If I look at the US, still very bullish on AI. I think AI is going to change a lot of things. So bullish on that. I'm bullish on banks in the US. I'm bullish on healthcare in the US. And both in India and the US, I would say once interest rates start to come off, do start looking at small caps, because these companies really benefit when rates come off. So definitely bullish on that also. What can we expect during elections? Typically, what we've seen, Kiran, is election year markets do extremely well. Unless obviously the verdict which is out is very different from what the market expects. So in India, if the Modi government comes, I think the markets are going to be euphoric. I think they will do well. But before that, you might get a reasonable correction, as I spoke about. In the US also, whether Trump comes or Biden, I think markets will do well. So I'm reasonably bullish on the markets into year end. Question from Himanshu: the way Sensex has been performing since last 2 years, what would be your take? Would it rally further? Does it look bullish? Himanshu, yes. The answer is yes. Do I feel, as I mentioned, I think there is a correction due. Correction could be anything between 5 and 8%. So you need to be ready for that. But am I bullish overall? Absolutely. I'm bullish on India. I'm bullish on infrastructure spend. I think the government is doing an amazing job. You have one of the best central bankers in India. I mean, what more would you really want? But short term, I think there'll be short term. I'm not as bullish, but as we go into July, August, September, I'm much more bullish. There's one more question. When you say liquidate one's portfolio by up to 30%, what kind of stocks would take priority to be liquidated over others? So I obviously don't know your portfolio. I've always believed that laggards, or which you've held over time, which have not done well, definitely look at them. Don't get emotional even if the stock you've lost money, because that doesn't really mean anything. You're looking at the future. You could also liquidate some of the IT stocks. Banks, I think one should keep. Infrastructure, one should keep. But some of these others you could definitely look to liquidate. There's a question from Gajendra. What's your take on the China market? Is this a good opportunity? Contra bet, as everyone is betting on China presently. Absolutely, Gajendra. That's I've actually been doing that. I'll be very honest. People are very bearish on China, and I know that. I've started buying. Obviously, you could get into the tech index in China. You could buy MSCI China, but definitely totally agree with you. Start buying, but buy it over time. In the sense, don't buy, if you want to buy 100, don't buy 100 now, maybe buy 25 or 30 now, watch the markets and then keep buying. But absolutely, I concur to your view. Keeping 35% out from equity, should you see investing post-elections? Absolutely. Kiran, I'm just waiting for a correction. I think the market corrects 5 to 10%. That's going to be an opportunity for you enter into the market. And if you don't want to trade at all, that's fine too. There are a lot of people who say, you know what, longer term, I'm bullish. I don't want to trade at all. That's fine too. I'm just saying, when there's an opportunity, if you don't have cash or liquid, then you will not have the money to invest. And that's the reason right now I'm telling people to take money out. Question from Sanjay. How do you perceive the interplay between fear and greed shaping investment decisions in the current Indian economic landscape? And what strategies do you believe could mitigate the investor's dilemma amid such dynamics? Great question. So right now, Sanjay, it's all about greed, right? A lot of people who missed out on the rally. In India, I guess people have not, but US people have missed out on the rally, right? So people are piling in. Every Tom, Dick, and Harry, everyone is cutting in. So there is obviously fear has been forgotten and is moved totally towards greed. And for that, my suggestion is either you hedge your portfolio if you have instruments through options, or if you can't hedge the portfolio, you liquidate the portfolio. Like I could buy options overseas, or I could liquidate part of my portfolio. So that's what I'm trying to do. But definitely, the investor's dilemma is always, oh, what happens if the market goes up? But that's okay. You've made money so far. And even if you don't make the last 3 to 5%, it's absolutely fine if you've got the trend. And I think that becomes very, very important. And if for any reason the market corrects 10%, then at least you'll have the cash to actually get into the market. Or if you put options, at least you would have protected your mark to market of your portfolio. One more question. When do you see PSU that are focused on infrastructure in the next? So as I said, I'm very bullish on the infrastructure, right? I mean, I go to Mumbai regularly, and just I just used the coastal road few weeks back. I mean, the infrastructure build has been huge. The MTR, which is coming, MRT, which is coming up. So I actually am very, very bullish on PSU stocks. I don't know how much they'll go up, but there's no reason why it could not double again in the next 3 years, which effectively gives you a 25 to 30% IRR. Thank you, Kiran, for that. Ajinkya, SEBI chief is very bullish on SM REIT. What is your take on it versus equity market? Is this a great product for a diverse portfolio? A great question, Ajinkya. I think it's amazing because longer term, if you see equity markets give around 14 to 15% returns. And this, I'm really talking about large caps, right? And if you see 7, 8, 10 years, these are the type of returns you get. Now with the SM REIT product, you get obviously returns, which are monthly, which is 8 to 9% on an annual basis. Plus you get capital appreciation of 6 to 7%. So you are looking at overall returns of 15%, which are equal to equity returns with passive income, which I think is amazing. And so the SEBI chief is also very, very bullish on it. And I'm actually very bullish on it. And I think now with the listing, which is going to happen, I think people should allocate 15 to 20%, if not more, into this instrument for their portfolio. There's a question from Kiran: investing in plot with greed or FOMO versus keep investing consistent in equity at all times of the market. Which will you long-term strategy or choice be? I would say keep your investing consistent in equity, and invest more when you see fear, because that's when you make the maximum money. There's a saying, there are times where if you don't invest, your returns will be subpar. And this we've seen, if you've not invested in COVID times, if you've not invested in crisis times, your returns will be there, but they'll be subpar. When you invest at that time, the returns are superlative. So consistency in equity is very important. Yes, do that. Plus, look at the times of fear, and that's when you go all in. I hope I answered your question. Thank you. So I don't see any more questions, but I'm happy to take more. There's one more question which has just come up. Can you give some clarity regarding tracking error with foreign funds? Should a small go for ETFs or mutual funds when it comes to foreign investment? A great question. In India, we have mutual funds. And in the US also, there used to be mutual funds before ETF. Mutual funds, obviously, people say mutual funds are supposed to beat the market, but they actually don't, unless the fund manager is extremely, extremely good. So my advice to you as a retail investor, go for ETFs. I also go for ETFs. I have a lot of ETFs in my portfolio. I don't have foreign mutual funds in my portfolio. I have Indian mutual funds. But I think with BlackRock coming into the market, I think they've joined up with Geo. I think they'll be launching a lot of ETFs. And the tracking error is not that much anyway. So my suggestion is, over time, ETFs are good, and their cost is very minimal. For example, the S&P 500, I think the cost is 0.15%. Mutual funds typically charge you 1 to 1.5%. So the costs are much, much higher. So as a retail investor, I would tell you to go for ETFs. So there's one more question. Considering I have a cash of 1 crore, should I consider a banker who should manage the funds? My advice is you can manage it, if you have the time to look at it. But don't go into single stocks. Go into funds, right? Or ETFs. Go into mutual funds, because I think they have professional people who manage it. And if you have the time, you can obviously research and go into single stocks also. But that's your call. I always say that people who don't have the time should go into funds. And people who have the time can do single stocks and funds both. Hiring a banker is obviously your choice. If you trust the banker, why not? I mean, there are very, very good wealth managers and bankers who people trust. And if you can find a banker you can trust, absolutely go for it. So if there are no more questions, thank you guys so much. It was a pleasure. I'm going to be doing this series every month. And I look forward to seeing you guys attend. And if there are any other questions or you'd like to know anything else, do feel free to reach out to the team. Thank you. Thank you so much.